Hey everybody, welcome to the Nerd Marketing Podcast. Today we've got Drew Fallon, who's the CEO of Iris Finance. Drew puts out some of the best content on D2C M&A on X. That led me to approach him and ask to come on the show today and talk about valuations and how to maximize your valuation and how Shopify stores can get this amazing big valuation. So that's what we go into. He shares his observations, and I think it's a really good episode for those CEOs and CFOs listening who want to have an exit someday. So I hope you enjoy. Drew, thanks for joining the podcast. The Nerd
of course,
Marketing
happy to be here.
Podcast. Can you tell us a little bit about Iris?
Yeah, Iris is effectively the financial operating system for retail and e-commerce brands. So essentially, I've spent the better part of the last decade in senior finance leadership roles, most notably / recently as CFO and COO of a beauty brand called Mad Rabbit. And I found that there was a glaring lack of financial planning and analysis tools within the industry that kind of catered toward this market, because this market has such unique requirements out of a tool like that. Like, sale, it's the only industry where sales can change every single day, and there's huge inventory requirements, and you're selling in different channels that have different margins, and it's so complicated that my belief was that there needed to be a really dedicated tool. And sort of the overarching vision for Iris is that if we can basically gain a critical mass of customers on the platform, we can use all of that information to actually train our own AI models to eventually take over the sort of fractional CFO role. So one of the things that you'll see us start to talk a little bit more about is sort of like the agentic modeling workflow, where you literally just type in to the computer and you say, build me my 2025 budget, and then it's done for you, and you can iterate and build as many of those types of models as you want. So that's kind of the gist of Iris.
Mike, we did a whole episode on budgeting and forecasting, which is now irrelevant, I guess.
Oh, nice.
Yeah. The reason, and we also wanted you on here because you put out some of the best content, I think, on the internet, let's say, but especially on X. I love it because Mike and I geek out on M&A, and we always like to see, what's happening to brands, and you are one of the best sources of deal information out there.
And the teardowns are really well done.
Yeah,
I appreciate that. They're less laborious than they used to be, but it's still a decent amount of work.
Where are you getting? Are these all they're not all Iris customers? I'm guessing you're getting some. Where are you getting?
No, yeah, they're all not Iris customers. I wouldn't well, actually, there's been some brands that have come to me and been like, I would let you use this for content. Sure. If you did it for free for me, basically.
Right.
Which I haven't elected to do, but yeah, no, this is everything that I post about is publicly available. It's all, it's just deep in the SEC filings, honestly, is kind of where you don't even know where to look if you haven't done this stuff. But prior to Mad Rabbit, I spent a couple of years on the sell side doing research on these types of companies. I covered Wayfair, Carvana, Amazon, Google, Facebook, all that good jazz. So they taught me where to look back in that day.
I'd love to hear sort of your take on recent trends, particularly in M&A, and how those have changed most recently. So there was this period, obviously, where D2C from a valuation perspective and investment perspective sort of fell out of favor a bit. Now you're starting, interestingly, we're in a weird macroeconomic climate at the moment, yet we're still seeing some interesting acquisitions from Poppy, just yesterday, and some other folks. So what's your take on how things have changed and where the state of play is today?
So I would say, okay, obviously you had the 2021 mania that probably leaked in 2022. 2022 actually didn't feel so bad. I was kind of out fundraising during that time. Mad Rabbit had a $10 million Series A. So this is a little bit different than M&A. But downtrend over the last couple of years, and I'm kind of on record as saying this is the starting gun of the race. So I do believe that we are back. And so as far as what I'm seeing, one of the main things, I track every deal in this industry, and like what I was really kind of blown away by over the course of 22 to maybe 24 really was like the only companies that were trading were like companies that had been around for like 30-40 years, right? And you're starting to see that duration kind of shorten. So for example, Poppy, like I mean it's still longer than it used to be, like it's still 10 years. But these Pepsi is paying, I think over 3x sales. There's an estimation on the sales front of that number, but like let's just say it's 3x plus sales. And so there's a slightly premium multiple for a slightly younger brand, which just tells me that people are getting like a little bit more eager, and it happened with Alani Nu and
I was just gonna
Celsius
say,
and
yeah.
yeah. And so like I think that like when you start to see these companies like really snap up, more emerging brands as opposed to like established like financial assets, right? It makes me really bullish because I think, in the case of Alani Nu, if you look at like and I think I sort of wrote something about this, but if you look at the top 10 energy drinks by like market share, they're all gone. Like they're all owned now by some big conglomerate, except for like the exception would be like Celsius, which is like a $7 billion publicly traded company, and then Red Bull, which is like $100 billion plus privately held company. But all of those like independent assets like are now sort of off the market. Like Monster bought Bang Energy. Alani Nu obviously was bought by Celsius. Ghost Energy went to Keurig Dr Pepper, and so now like if I'm like Coca-Cola or Red Bull or whoever else, I'm looking around and I'm saying, oh shit, I just completely missed that. So I missed the energy trend, but I can't miss the next one. And that's like obviously like the psychological sort of cycle that begins the bull market. So I don't know how like public stocks are gonna behave, and I don't pretend to know that. But I do think based off of my observations, like I feel pretty optimistic about the sort of 20 to 25 maybe for M&A is in this category too, for sure.
And if you're operating a brand today, in your opinion, what do you optimize for if you're looking to either raise or ultimately have an exit?
Yeah, it's such like a hard question, right? Because by the time you answer it, it's already changed again. In the business world, right? Because like if we decide that we're going to optimize for revenue growth, like it might take us 6 months to actually start to move that, unless you're like extremely small, nimble kind of team, which a lot of these brands are. But um, I think you have to maintain focus on your profitability. I think you can just have a little bit of hope at this point, that you know, like the sort of minority capital markets will unlock. Um, so I think like, because like these big strategics are buying, it kind of makes private equity a little bit more comfortable buying, because they see a path towards liquidity to the strategic buyers. And it's not as linear, but then the VCs get a little more comfortable buying because they see liquidity to the private equity. And so it kind of like you need like the domino to go before the markets really open up. And so I think you're never gonna lose. Like it's never. I don't know that we'll ever get back to like the mania of 2021. At least not like in like my lifetime, maybe. But I do think that growth will come back into favor, but like decent growth, not like growth at all costs kind of a thing. So I think if you're a brand, if you're doing below 50 million in sales, like first, like it doesn't really sort of apply to you. I don't think, at least not like in the near term. Um, but I do think you can you can start to look at your model and kind of wonder how are we going to push the gas a little bit, because at the end of the day, like you do want to be growing. If the last couple of years you kind of focused you cut all costs and you're shrinking revenue. Like if you're shrinking revenue, you're just never going to be like valuable anyways. I mean, maybe you could trade off of like some shitty EBITDA multiple, but um, yeah, I'm curious what you guys think. Like, do you see like clients kind of starting to shift focus, or what do you think in general?
Well, I really like something you said just a moment ago about cutting and revenue shrinking, and I think it's an important thing that we talk a lot about, which is like you can't cut your way to growth. And yeah, I mean, if you're thinking short-term survival mode, maybe you just have to do whatever it takes to keep the lights on. But if you are actually thinking
Hmm.
about how do I make this a brand that has significant enterprise value going forward, you got to invest in actual growth, and you got to start being able to expand your top of funnel and drive growth outside of like core bottom of funnel circling the drain type activities. And I think we're seeing a lot more brands start to do that and open their eyes, maybe because they're reaching a greater level of scale and they're starting to tap out on Meta as being the diminishing returns. They're starting to see significantly more diminishing returns, or maybe it's just because they're becoming more wise to the notion that to continue to grow and to become a big company, you've really got to expand outside of that universe and build broader top of funnel awareness for people that aren't in market at the moment.
And it's such like a tricky balance, right? Because like you see like the pendulum always swings. Like you got to be growth and profits don't matter, or only profits matter, or you're not in retail, or you're in retail. Like it's such like a moving target. So I think you can't like over rotate on like any one deal or headline or whatever, but it is kind of like a slow assessment of like we have to like shake or bake kind of a thing. And it's not like if you make the wrong call, you can't like undo it a lot of the times. But to answer the question maybe a little bit more succinctly, like I'm not changing my business plan, but I'm feeling pretty good about the opportunities ahead of me.
And what are those? As the operator, sort of with the CFO hat or the Iris hat on, like what are some of those core KPIs that you're tracking most frequently, or that you're really focused on, and that you think brands should focus on?
Yeah, so in the so Iris, we have a lot of retail companies. I'll maybe just speak like a little bit kind of on like the e-commerce stuff that we really focus off. I mean, I think one of the healthiest things that kind of came out of the downturn is just like this idea of like tracking your contribution margin. And there was this like whole debate for like 2 years basically of like what even is that? And I think that was a really healthy question for folks, because I think it's fairly intuitive to understand, right? Like contribution margin, like in general, is like a fairly obscure like management accounting like no like idea. But because like our businesses like in e-commerce, like because we have such high variable cost structures, it kind of got forced to the forefront. And so I think like daily contribution margin tracking, and this is like probably a little bit biased to the Iris side, but it's paramount. I mean, like fixed expenses are fixed and variable is variable, and so just like aggregate contribution margin is almost like still the North Star KPI. I think even in the era of growth, because it kind of comes back to what I said earlier of like you want to grow, but like you don't want to be burning contribution essentially. Like if you can break even on contribution, like if you have any semblance of repeat in your business, like you're going to be in an okay spot. Whether or not you're spending $1 billion on OpEx, it almost like doesn't even really matter, honestly, because it's not really indicative of like the actual business, at least maybe not to a certain extent. But like you're seeing contribution margin obviously like stick, and then kind of the derivatives of that, right? So like LTV to CAC, which was like never, it was always like talked about, but never truly understood, I don't think. And then eventually people kind of realized that like, okay, like LTV is contribution margin in that calculation. It's not revenue. So I've seen a lot of people think a lot about more about their LTV to CAC. Similarly, like as we abandon this idea of LTV, some people are even saying like AOV to CAC, because I don't want to say abandon the idea of LTV, but wish less for future purchases, and take what we have sort of, when we get it. So yeah, anything with like a sort of CAC denominator, I think is like a healthy metric to track. And if you can even kind of proxy it towards, first order contribution, that's going to be pretty healthy. Yeah, I don't know if I have anything kind of to add beyond that. Are there like specific KPIs that you guys kind of like to like point to for post pilot, or anything that you believe kind of captures the essence of the funnel itself?
Yeah, incremental revenue, incremental ROAS is typically the North Star that brands are looking at.
Okay.
So
yeah, interesting. So with Iris, we don't do any we have like a hard line in the sand. Like we're not like an attribution tool. Like we're not an incrementality tool. Cause like I candidly think that stuff is like very like opaque. And we're basically like a financial system of record. So I just like, I'm uninterested in it, but I do think it's really important for people to go to other places to find those things. Because you can kind of, it's a lever. It's a lever for changing the contribution margin that we want you to look at. We're just not today telling you exactly all the tips and tricks to kind of like move to inch it forward, which maybe is a weakness of ours, but it's just so hard to like do accounting basically for like incrementality.
Oh
like
yeah, and there's a million
yeah.
other tools that can help you with
Exactly.
attribution,
Yeah.
MTA, MMM, whatever it
Totally.
is. So yeah.
That's kind of the I'm like, look, if you want that, like you can just go somewhere else. There's a million of them, like you said.
Right.
So if you were running a brand, you already touched on one lesson, which was like get over 50 million in revenue. If you're looking for an exit or to maximize your exit, would the other lesson be become a beverage brand?
Maybe, yeah, honestly. Like it's
seeing
funny because like
are you seeing anything in any other category?
No. Short answer, no. Like food and beverage, specifically beverage, is like what's going on right now. I mean, I do think supplements are having like a bit of a moment as well. I think those dominoes are going to start to tip though, kind of Q2, Q3, maybe into the end of the year. Like I think the ProMix acquisition was actually a really important deal. You haven't seen the trickle down of that just yet, but I know of a lot of adjacent brands, maybe not like the fitness protein, but like supplements kind of in general, that are starting to kind of attract certain buyers. And it's interesting because they're often kind of beveragey too. Like Liquid IV, for example, like it's like supplementy, but is it a beverage? Like it's a little bit of both.
Mm-hmm.
So I think like, by far right now, like beverage is easily the hottest thing in the world. I mean, specifically energy. And then like, I'm curious what you guys think of this. I think like the better for you trend kind of like kicked off from like a venture perspective in like 2014, 2015 ish, maybe even through like 2017. And I think you're just like seeing a lot of those funds like start to kind of return. And that's like, it's been like the 10 years or whatever. And so I think that, it started with like the sort of obvious like food and beverage. And I don't know what your guys' firsthand experience with this is, but like there are funds like Boulder Food Group, BFG, where like, they kind of stamp their flag on better for you food and beverage. And then by like 2020, 2021, it's kind of like, there's not much left to do here. There's only so many better for you oatmeal cakes that can like, pop up. And so like, though, and I don't mean to call out BFG specifically, but like funds in that category, they're just a really well-known one. They started to kind of think about beauty products, and they started to even look towards enablement. And so they started to diversify with fund, 2, 3, 4, 5. And so I think like the next wave, you'll start to see like some of those, targets get acquired. But for right now, it's all about food and beverage.
Yeah, I think the last thing we heard at a very high level, there were a lot of apparel brands being bought out by apparel roll-up companies.
Yeah, did you guys see the Guess thing today? I haven't really had a chance to dig into that, but
no,
I didn't
there
see
was
that one.
WHP just put in a bid for Guess. Like it's apparently
wow.
Guess is public for whatever reason. The apparel stuff, it's such a train wreck. I mean, it's actually worth calling out, Drew. It's worth calling out because it is happening. But it's just not exciting. It's like kind of like bottom feeding buyout type stuff. Like every single apparel deal that you've seen has been trash, like probably cashless too. Like the Feet one, the Rowing Blazers, like Rag and Bone, like these are all like zeros. But it's worth highlighting though. I do think like there's like some level of consolidation in apparel for sure. It's just not exactly making people rich.
Everybody who listens to this who runs an apparel brand like crying right now.
Well, we have We've got a number of really exciting apparel brands, and like I've been, our companies will come to me and ask for fundraising advice a lot of the times, and if apparel is the one category where like even if you're crushing, I kind of go, I don't really know, because there's so many people that just like I don't do apparel, we don't do apparel, no thanks, won't look at it, like they don't even look at it, and I'm kind of like, but these are like really nice businesses with like large markets, and like if you boil it down to like the LTV levers, like apparel is the best category. It's the hardest from a supply chain perspective, but it's the best one from a revenue perspective, because what other category can you get somebody to spend $300 with you 5 times a year, right? Like there's no other category. Um, so it's tough. It's really tough.
That's interesting. I think is it the riskiness that if you don't get the merch right, or you're not on trend, that the business could go down just as quickly as it goes up.
Yeah, they're kind of fragile businesses, honestly. Like you really have to nail it. And like I've written a lot about Allbirds, which I mean, I'm sure you guys are familiar with the story. Like it's just like fell off a cliff. They were the hottest thing ever. They went freaking public. And then, all of a sudden they're in the gutter. And then it's like what ends up happening is like, how like apparel brands have like Lululemon has like the "we made too much" like section of their website. Are you guys familiar with that?
Mm-hmm.
Yeah, so like what happens is like it's March, there's some trend that's going on for the summertime, and like, we don't make enough in time or whatever, and so now it's September, and like we didn't sell enough of our new shorts that were supposed to be hot for the summertime. And then you have to like discount to like move that product, like we made too much, it's like half off or something. And all that does is the more that you mess that up, the more it drags on your gross margin. And the more that it drags on your gross margin, the less dollars you have to reinvest in customer acquisition or even like remarketing. And then the less that you have to drive revenue, the slower that inventory turns anyways. And so it's just like this terrible death spiral. And like, I think when you combine that reality with the fact that like consumers are just like tough to please on like an ongoing basis, like I get why people are afraid of it, but I think like the niche, power brands that are like really servicing like an audience that like isn't going anywhere, I think they're some of the most powerful businesses that there are. It's just so hard to nail it. It's so tough. It's like yeah, I don't know if I would ever get into that one, to be honest with you.
We've had Mike Mahar on here before, who's a buddy who runs Taylor Stitch, and they've done really well.
Okay.
They are now backed by Carson Bitterman in Boston. He runs Digital Fuel Capital, so they're doing essentially like a men's apparel roll up called Digital Stronghold. They've got
Oh, cool.
Boston Scally, they've got the Thai Bar. There might be a fourth company there, but they're just gradually adding these apparel brands, buying them, I believe, on an EBITDA multiple, and just the thesis is they'll get big enough and then have a bigger exit someday at a higher multiple.
It's a classic multiple arbitrage.
What's your thoughts on that too? Everyone's always asking, how do I get to a revenue multiple versus an EBITDA multiple? What are the characteristics that you think differentiate the valuations?
This is, Michael, a fantastic question. Because the answer is they're not different. It's the same thing. That's like, so like oftentimes companies will, say, or yeah, like the press release will say, Ghost Lifestyle was bought for 3x sales. The sales multiple is one of two things. It's either a hypothetical earnings multiple or it's an earnings multiple, right? And so like if we are let's just say like we're a company that does 10 million in revenue and we have 20% EBITDA margins. We're doing 2 million in EBITDA and we sell for 30 million. That's 3x sales, right? Or is it 15x EBITDA? Or is it both? It's both, right?
Yeah.
And so like, the reason that like I always report on the sales the sales numbers because it's the most widely reported multiple, like across the brand. It's the easiest way to compare brands. Like nobody ever comes out and is like, well, actually, I mean, Celsius did it in the case of Alani Nu, which is a whole other conversation where they were like, they called it 12x, and it was really like, adjusted pro forma, fully synergized EBITDA was
Oh, really?
12x.
I didn't dig in.
It's so funny, man. They had it's like they had 69 million in net income, and Celsius found a way to adjust it up to like 135 million or something. So like the headline number was 12x, which is like a really modest, really modest acquisition. But really they paid 26x, which is like desperation.
Wow.
So I thought I thought it was pretty funny. But yeah, you don't get valued on sales or get valued on earnings.
Sure.
You just get valued, and then like, those are outputs. Like it's just like it's the classic like you're worth whatever somebody's willing to pay, and like usually they're willing to pay somewhere around like where somebody else is willing to sell, kind of a thing. And so like that's like why comparables even it's like buying a house, right? Like yeah, so that's like something that honestly that we could unpack in like a whole episode about sort of the sales versus EBITDA multiple, because like I get pissed when people are like, I'll like say like, I don't know, Allbirds is trading 0.2x sales, and somebody's like, well, they don't trade on sales, it's trading on an EBITDA multiple. And I'm
Right.
like, well, yeah, but it's the same freaking thing, you dumbass. So people do need to understand that a little bit better, honestly.
This is in your X comments.
Yes,
People
generally
say it like
speaking.
that. Okay.
Yeah.
Yes.
That tone of voice.
They send me voice notes. That's literally how they sound.
Yeah.
Love it.
So you were both like, you were a CFO and you were a CMO too, right? Or I guess you're a CMO now.
I was no. Oh no, I was never a CMO. I would never pretend. I was the CFO at Mad Rabbit. And then I was a COO. Now I'm the CEO of Iris.
But
I don't have what it
you're
takes to
actually
be
doing
an MO.
you're doing the marketing too at Iris. That's what I meant.
Oh, sorry, I
Most
misunderstood.
part.
Yes.
Yeah.
In that regard, I am the CMO.
How do you? We did an episode on like how CMOs can communicate better and work better with CFOs. It's one of our more exciting episodes, Mike.
Yeah.
What do you do? You have any tips like for how to get along with your CMO? I mean, I guess you were a D2C CFO. Like, did you work closely with the CMO?
One of the most important relationships in a business. So curious how you think about how CMOs can communicate better with CFOs and vice versa.
This is the most important topic of the last 10 years in our industry. And in the sort of what I've been kind of preaching about is like the CMOs, they know how all this stuff works because the marketing in D2C is like it's the foundation of the entire business. Like when I build a financial model for someone, if I do that these days, the first number that you type into the Excel sheet is the ad budget. It drives every other possible inventory purchase. It drives every cash flow. It drives every repeat rate. It changes everything. And so, when you think of like the CMO kind of in one corner and then the CFO kind of in the other corner, and they're both like doing business analysis, as long as the CFO is like decently strategic and it's not just like some like boomer credits and debits kind of guy or gal, they're kind of looking at the same stuff. And it's like an equation, right? Like it's like an equation from left to right. And at some point, the conventional CMO stops understanding the equation, even though they're going down the same equation. And then similarly, going down the other way, the CFO kind of stops to understand the equation, stops understanding the equation. And if they would just start reading the equation a little bit more, they would realize that they're feeding into each other, right? So like CPMs like change my balance sheet cash at the end of the period. If I have a model with like a CPM input, I could play with that number. But like the CMO, as soon as they get to the balance sheet, they just shut off. And they're like, I don't know what that means or what any of that stuff even is. And similarly, typically the CFO, as soon as they get to the ads manager or whatever, they just shut off and they're like, I'm a CFO, I don't know any of that stuff. When in reality, it's all just algebra. And so, what is the point where those two folks stop progressing? It's actually at contribution margin. So contribution margin is the output of all the marketing, and then you get down to like the P&L, and you're at like the OpEx line, and you're like, and then the CMO goes, okay, not my job anymore, because now we're talking about fixed expenses and balance sheets and cash flows and that stuff. And then the CFO, they'll go the other way, starting at like cash flows, all the way through OpEx. And then they're like, okay, well, everything else is controlled by marketing, so not really my problem. But like, if you can get this is my whole theory with Iris, honestly. If you can get the whole the CFO and the CMO both looking at the same contribution margin, and not just like the same formula, but the same number in the same platform, that's where you can really achieve sort of transcendent, alignment within like performance of these businesses, because you have the CFO building the budget who can actually understand how that budget is being manipulated, how it's, how the levers are being pulled and all that stuff. And then you have a CMO who actually understands that they are driving the performance of the entire business. So I've been talking for a little bit too long right now, but like it is kind of a hot point for me where like that was like why I started all of this. Honestly, it's extremely important. And if you can get these people to look at the same contribution margin number, then I do think it will go a really long way.
Love it. Should make it available for SaaS.
Yeah, somebody needs to make this this tool available.
Yeah, it's funny because I'm actually like looking for like a fractional CFO right now for Iris, because I was like, it doesn't work for Iris. Like I actually do use the cash flow model in our platform for my business. But like there's no AOV in my, in software. So it's kind of like, it's tough, but yeah, I totally, there was a couple of people that tried it.
Well, Drew, awesome. I know you had to punch out. So I thought we could just wrap on that. I really appreciate you coming on.
Yeah. Well, if you want to hear Drew nerd out on finance with our other buddy, Maytab, both really sharp guys, they now have their own operators podcast, one of our favorites. We love operators. We love marketing operators. And now we love finance operators. One of the best.
Oh yeah.
The few that I actually keep in my rotation.
We're 2 episodes in, so hopefully we get better and better. Appreciate the plug.
Yeah, awesome. Well, thanks for coming on and good luck with everything.
Yeah, thank you guys so much for having me.